Imagine a local independent coffee shop.
Okay.
You know the kind, right? Like exposed ductwork, $20 pour-overs.
Oh, yeah, the hipster spots.
Exactly. And they've got a line spilling out onto the sidewalk every single Saturday. Now, in a typical 3-month stretch, that single brick-and-mortar cafe is easily pulling in $30,000, maybe $40,000 just to cover the beans, the rent, and the payroll.
Easily, yeah. Probably more.
Right. Now, contrast that image with a publicly traded technology company currently valued by the market in the hundreds of millions of dollars.
That is quite a pivot.
I mean, a company that is supposed to be riding the absolute crest of the artificial intelligence revolution, partnered with some of the biggest semiconductor foundries on Earth, and yet this tech darling is generating less quarterly revenue than that single corner coffee shop.
It's a phenomenal juxtaposition, honestly. You are looking at a market valuation engineered almost entirely out of future expectations. And it's just colliding head-on with a present-day operational reality that is, to put it mildly, microscopic.
It really is. Well, welcome to the deep dive. Today we are pointing our lens at Lightwave Logic. The ticker is LWLG.
Right.
And if you follow the infrastructure side of the AI boom, you've likely seen their name floating around the electro-optic polymer space. So we're working from an in-depth equity research report dated today, August 14th, 2026.
It's a heavy one, too.
Oh, massive. It's this huge synthesis of SEC filings, technical charting, and market sentiment pulled from U.com research and FinHub. And our mission for you on this dive is to dissect this chasm between the narrative they are selling and the balance sheet they're actually reporting.
Because we really need to figure out what the market is actually pricing into this stock right now.
Exactly.
Because the narrative is undeniably intoxicating. The core thesis of Lightwave Logic rests on their proprietary perkinamine technology. I mean, anyone watching the massive build-out of AI data centers knows we are slamming into a physical wall right now.
Right. It's literally a physics problem at this point. We are trying to push unprecedented amounts of data through traditional copper infrastructure.
And copper means electrons.
Yeah, electrons mean friction, and friction means heat. AI data centers are essentially melting, so the bottleneck isn't just software anymore, it's thermal dynamics and bandwidth limitation.
Which is exactly where Lightwave Logic enters the chat. The promise of their perkinamine polymers is to fundamentally shift how data is transmitted, moving away from electron-heavy copper and toward photons, light.
Right.
By using electro-optic polymers to modulate that light, the pitch is that you can transmit data at vastly higher speeds with a fraction of the power consumption and, crucially, a fraction of the heat.
It sounds like the holy grail for, companies building out hyperscale data centers, and the research report highlights that this isn't just a science project happening in a vacuum.
No, they have actual industry backing.
Right. Lightwave Logic has established foundry partnerships with some incredibly heavy hitters in the semiconductor space. We are talking about Tower, Global Foundries, Silterra.
These are the fabricators that actually build the backbone of the tech economy.
Exactly. So from a narrative standpoint, you have a proprietary solution to the biggest bottleneck in AI, validated by partnerships with top-tier foundries. I mean, it looks like a golden ticket.
It looks like it, yes. But here is where we hit the concrete wall of their financial filings.
Yeah.
When you peel back the press releases and the foundry announcements, Lightwave Logic is fundamentally a pre-commercialization company.
Yeah.
And I use that term very intentionally, because the revenue figures we are seeing in this equity report are they're startling.
Okay, let's unpack this because we just need to put the raw numbers on the table here. They demand context.
Go for it.
For the first quarter of 2026, their total reported revenue was $29,167.
Wow.
Not $29 million. $29,000. And the Q2 numbers, which dropped just a few days ago on August 11th, show approximately $30,000 in revenue.
The scale of that disconnect is what we really need to focus on. When a company is valued in the hundreds of millions but pulling in 30 grand a quarter, you aren't looking at a commercial enterprise. You are looking at an R&D laboratory that just happens to have a ticker symbol.
It's like building a state-of-the-art billion-dollar factory, hyping it up to the press, but only selling one single widget a month. And it's an expensive laboratory at that, because while the top line is flatlining around 30 grand, the bottom line is bleeding out.
Vast.
Yeah, their net loss for Q1 of 2026 widened to $6.301 million. That's up from a $4.697 million loss in the same quarter last year. My read on this is that as the global AI narrative accelerates, their financial reality is actually moving in reverse.
It is. And if you want a metric that captures the severity of that cash furnace, just look at their trailing 12-month net margin.
Yeah.
The report pegs it at negative 8,724.83%.
Wait, negative 8,724%.
Yes.
This is a staggering number to digest. I mean, for every single dollar of revenue they managed to scrape together, they are setting almost $88 on fire to get it.
Exactly. And we have to ask why. Why is the cash burn accelerating while the revenue remains flat? This is the fundamental friction of scaling hardware versus software.
Okay, how so?
Well, if Lightwave Logic were a SaaS company, scaling up to meet the AI boom would mostly be a matter of server capacity and customer acquisition cost. But they are dealing in physical chemistry and semiconductor fabrication. Transitioning a novel polymer from a controlled lab environment into the highly standardized, incredibly rigid manufacturing processes of a global foundries or a tower that takes massive capital expenditure, relentless testing, and just time.
It's the difference between writing a new app and trying to change the metallurgical composition of a car engine while it's driving down the highway.
That's a great way to put it.
The foundries can't just flip a switch and start mass-producing Perkinamine components.
Right, which means those millions in quarterly losses aren't necessarily mismanagement.
Okay.
They're just the inherent brutal cost of trying to cross the chasm from prototype to commercial scale in the hardware sector. But for you as an investor or an observer, that distinction doesn't really matter.
Because the cash is still gone.
Exactly. The bottom line is that you are investing in a company that is paying a premium just for the privilege of operating.
Which naturally forces us to look at the market mechanics here. Because the immediate question is, how does a stock with a negative 8,000% net margin and 30 grand in sales sustain a multi-$100 million valuation?
It's all about the narrative.
Right. I'm looking at the price action in the report, and the volatility is severe. On August 13th, the stock took an almost 9% hit, closing at $7.29. But the last 13 weeks tell a very different story. A 52.49% decline in 3 months. That isn't just a dip. That is a structural re-rating.
The euphoria is colliding with the earnings reports. When the market expects the commercial floodgates to open and management delivers another quarter of $30,000 revenue,
the narrative premium evaporates.
Exactly. The market is slowly realizing that a partnership announcement is not a purchase order.
Let me challenge that bearishness for a second, though, because I'm looking at the technical analysis breakdown in our sources, and there's an argument to be made that this 50% drop is just, healthy consolidation.
Okay, I'm listening.
So the relative strength index, the RSI, is hovering around 59.24. That's dead neutral. More importantly, at $7.29, the stock is still holding above its 200-day moving average of $7.11. For a technical trader, as long as it stays above that 200-day line, the macro trend is arguably still intact. Couldn't you view this recent bleed out as the market simply shaking at the weak hands before the next leg up?
You can certainly make that technical argument. And it's true that the 200-day moving average is providing a psychological floor right now. But we also have to note that it recently sliced below its 50-day moving average of $7.94.
Right, short-term pain.
Yeah, which signals that the near-term momentum is broken. But frankly, debating where the moving average is crossed feels like missing the forest for the trees when you look at the fundamental valuation multiple.
You mean the price-to-sales ratio?
Yes. Look at the PS ratio in this report. For a high-growth tech company, a PS of 10 or 20 is aggressive, sure, but justifiable if the revenue growth is exponential.
Sure.
Lightwave Logic's PS ratio is sitting at 4,620.
Oh, man.
And depending on the data feed, -theu.com, has it spiking up to 7,560.
I'm staring at that multiple, and it almost doesn't compute. A PS of 4,600 means the market is entirely disconnected from current operations. In what universe does a hardware company command a multiple that makes early-stage SaaS companies look like deep-value stocks?
In a universe where the market has completely decoupled the stock from the underlying business, the market isn't pricing Lightwave Logic.
No.
No, it's pricing the total addressable market of AI data centers. The danger of a 4,600 PS ratio is that the company is priced for absolute flawless execution.
And nothing is flawless.
Especially not in semiconductor manufacturing. Flawless execution is a myth. Delays, yield issues, integration friction, these are the realities of the foundry floor. When a stock is priced for perfection, any disruption to the timeline is devastating to the valuation.
And speaking of timelines, that brings us to the most critical constraint for any pre-commercial company, the runway.
Yes, the ticking clock.
Because with a cash furnace burning at over $4 million a quarter, time is quite literally money.
But I'm looking at their balance sheet, and ironically, survival doesn't seem to be their immediate problem.
No, they actually have a surprisingly robust liquidity cushion. As of Q1 2026, they reported $75.103 million in cash and cash equivalents, and their total liabilities are impressively low at just $4.6 million.
That's not bad. Not at all. They aren't heavily levered, and they aren't facing an immediate liquidity crisis.
But let's apply some logic to that $75 million vault. Their operating cash flow in Q1 was negative $4.061 million.
Right.
If we flatline that burn rate, they mathematically have years of runway. But as we just discussed, scaling hardware isn't a flatline expense. When they finally transition from testing perkinamine in a lab to mass producing it on a foundry floor, their capital expenditures are going to spike, right?
Dramatically. The cost of commercializing physical technology scales up, not down, as you approach production. So that $75 million is going to drain much faster once the actual manufacturing gears start turning.
Which introduces the real latent risk for anyone holding the stock right now. If they aren't going bankrupt tomorrow, the threat isn't insolvency, it's dilution.
Absolutely.
If I'm an investor, I'm essentially holding a cocktail. Every quarter that management fails to secure a massive commercial contract, the company burns through a little more of that $75 million. Eventually, they will have to go back to the capital markets to raise more cash to keep the lights on.
And how do they do that?
Well, because they have negligible revenue, debt isn't a great option, so they issue more shares. They basically pour more water into my cocktail.
That is the exact mechanism of dilution.
Wow.
The overall value of the company might remain the same, but your individual percentage of ownership gets thinner and less potent with every secondary offering.
It's brutal.
It really is. For a pre-revenue company, time is the enemy of the current shareholder. The longer the timeline to commercialization, the higher the probability that you will be diluted before the technology ever turns a profit.
And that dynamic, the massive valuation, the widening losses, and the looming threat of dilution, it's bleeding directly into the broader market psychology. Let's look at how the street is interpreting this ticking clock, because the sentiment data in our sources is remarkably grim.
The consensus has definitely shifted from optimistic speculation to rigid spreadsheet analysis.
The bearishness is practically jumping off the page. There's a Seeking Alpha analysis from July 29th that flat out labels the stock too risky.
Harsh but fair.
Right. The author explicitly argues that the weak Q2 revenue makes it a dangerous play, completely dismissing the fact that the price had fallen to what some technical traders were calling attractive levels. And then the U.com research points out a fascinating dynamic. The company has been announcing these customer wins, but those announcements are being completely ignored by the market because they aren't translating into top-line revenue. The overarching analyst consensus has calcified into a firm sell.
And our primary research report synthesizes all of these headwinds into a final quantitative score. They give Lightwave logic a 3 out of 10.
Ouch.
Yeah, with a strictly bearish stance. The rationale is clear. The PS multiple is indefensible. The commercial revenue is non-existent, and the market is in the middle of violently recalibrating its expectations downward.
I hear all of that, and the logic is sound. But I have to throw a wrench into this bearish thesis because there is one data point in this report that completely contradicts the sinking ship narrative.
What's that?
If the analysts are screaming sell and the cash burn is an inevitable march toward dilution, human nature dictates that the people inside the building should be quietly heading for the exits.
Ah, you're talking about the insider activity.
Exactly. I'm looking at the insider transactions, and there's virtually no selling. The report flags one open market sale of exactly 345 shares.
That's nothing.
It's completely immaterial. If the executives know the technology can't scale, or if they know the foundry partnerships are just smoke and mirrors, why aren't they cashing out their stock options while the valuation is still elevated?
It's a fair question.
Right. Does management possess asymmetric information here? Are they diamond-handing their shares because they know a massive landscape-shifting contract is imminent?
It is an incredibly tempting puzzle to try and solve. I'll give you that. But if we connect this to the bigger picture, we have to apply some rigorous logic here. A lack of insider selling is not a substitute for a commercial contract.
But it implies confidence, doesn't it?
It implies a variety of things. It could imply lockup agreements preventing them from selling. It could be blackout periods around earnings.
Sure.
Or, quite often in the deep tech space, it implies that the founders and engineers are true believers in their own physics. They've spent years developing these polymers. Their conviction in the technology is absolute.
They drink their own Kool-Aid.
Exactly. But conviction does not equal commercial viability.
So their faith in the science doesn't negate the math on the balance sheet.
Precisely. The market extended them an enormous valuation premium based on a theoretical promise. The burden of proof is now shifted entirely to the management team.
Yeah.
The time for press releases about testing phases and MOUs is over. To defend this valuation, management has to produce binding 8K filings detailing commercial contracts with 6- or 7-figure revenue commitments.
Minimum.
Right. Until those filings hit the SEC wire, the lack of insider selling is just an interesting footnote, not a catalyst.
So as we pull back and synthesize all of this for you listening, how do we frame the current reality of Lightwave logic?
You have to view them as a company caught in the most dangerous phase of the corporate life cycle. They possess a potentially revolutionary technology in the electro-optic polymer space, perfectly timed for an AI hardware sector that is desperate for solutions to heat and bandwidth bottlenecks.
The narrative is flawless.
Yes, and that potential earned them a massive valuation. But they are currently attempting to cross the brutal chasm from an R&D entity fueled by narrative to a scalable manufacturer fueled by cash flow. And their current financial reality, $30,000 in revenue against millions in losses, shows just how treacherous that crossing is.
For the observer keeping tabs on this sector, the roadmap is actually quite simple. Ignore the daily volatility in the press releases. The only milestones that matter over the next 6 to 18 months are the SEC filings. You are looking for an 8K announcing a binding, capitalized agreement with a Tower or a Global Foundries. And in the quarterly reports, that top-line revenue needs to finally break out of the tens of thousands and into the millions, signaling that the Perkinmean technology is actually moving off the lab bench and onto the server racks.
If those metrics remain stagnant, the physics of their burn rate will eventually force a dilution event, regardless of how promising the underlying technology might be.
It's a fascinating, high-stakes standoff between science and finance, but I want to leave you with a final, lingering thought to dissect on your own.
Go for it.
We've established the severe bottleneck facing the AI sector. The biggest players on the planet, Microsoft, Google, Amazon, they are pouring tens of billions of dollars into data center infrastructure, and they are acutely aware of the limitations of copper and heat.
Very aware.
So if Lightwave Logic's polymer technology is truly the silver bullet that solves the defining hardware crisis of the AI revolution, why hasn't a trillion-dollar tech giant simply acquired them?
That is the million-dollar question.
Right. Why haven't they aggressively funded the commercialization phase to lock down exclusive rights to the technology? Does this prolonged, low-revenue, pre-commercial purgatory suggest that taking these polymers from a controlled laboratory and integrating them into the global semiconductor supply chain is vastly harder and vastly riskier than the optimistic narrative wants to admit?
It really makes you wonder.
It's the ultimate question of whether a brilliant science project can survive the sheer friction of the factory floor. Keep an eye on those SEC filings, watch the cash burn, and see if the reality of the balance sheet ever manages to catch up to the dream.